Good evening, everyone. Can you hear me? If I could ask those of you at the back to please come forward. There are seats in the front too. Don't be bashful. Thank you. Okay. So good evening, everyone, and thank you for joining us this evening for our inaugural Spotlight on Financial Services series. So for this whole week, we're having sessions in Melbourne and Sydney where industry experts are discussing the latest issues facing the financial services sector. But today, we are focusing on the property sector and property funds in particular. So I'd like to begin by acknowledging the Wurundjeri people of the Kulin Nation, the traditional custodians of the land I am presenting from tonight. I recognise their continuing connection to land, waters and culture, and I pay my respects to the elders past, present and emerging, and to all First Nations people joining us. My name is Harry New. I'm a senior partner in the firm's National Banking and Financial Services practice, acting for many property fund managers. The current real estate market is presenting different challenges for property fund managers than those they've faced for 10 plus years. Uncertainty abounds. High inflation is stubbornly not going away. Interest rates are rising, governments are spending, developers are falling, businesses' practices are changing, and investors are nervous. For example, offices produced a 10-year total return to December 22nd of 10.3% per annum. That was care of Atchison report, but now seems to be an unloved asset class. Retail was considered a basket case and seems to be making a comeback. So tonight we've assembled a panel of industry experts who'll discuss how property funds are managing the current market and the potential opportunities coming out of a changing real estate landscape. An interesting proposition indeed. So I'd like to welcome our eminent panelists for this evening. Chris Langford, Joint Managing Director, Newmark Capital. Melissa Kingham, Executive Director, Haven Property Group and President of the Property Funds Association. Louise K.L. Malvo, General Manager, Social Infrastructure Funds, Australian Unity. And Daniel Moat, Head of Legal at Qualitas. Thank you all for agreeing to be with us this evening. Some logistics, please turn off or silence your mobile phones if you haven't already. And also note that this session is being recorded. The intended format of the panel discussion will be the panelists will first respond to questions for about 45 minutes, and we will then take questions from the audience, although I think it's an intimate enough crowd that if the context allows, we might take questions earlier if they're burning, but let's see how we go. So I'll now hand over to my colleague, Vanessa Murphy, a special counsel in our corporate funds team, to direct questions to the panelists. Vanessa.
Thanks very much, Harry. So we'll start off with our panelists today, just hearing a bit about each of them, what their organisations do and what their organisations are focused on at the moment, particularly sort of the asset classes that are forming part of your strategy. So Melissa, perhaps we'll start with you.
Hello, my name is Melissa Kingham. Harry already introduced me as Executive Director of Haven Property Fund. For those of you that haven't heard of us, you will. For those of you that have, welcome as co-investors. We are specialist property fund managers that focus on retail shopping centres and really on value creation. So not just on the shopping centre itself, but on the land that that shopping centre sits on. I've been in retail property for close to 20 years. So when people say that we're going through a purple patch, I've always seen it as purple. You must have been colourblind up until now. But yeah, that's me. I also have another role that I play when I'm not working around the clock with Haven, and that is I'm president of the Property Funds Association. Harry New is actually the chair of our regulatory committee. The Property Funds Association is the peak body that represents direct property syndicators and investors, and has the direct relationship with ASIC in relation to regulation and how we actually deal with AFSL license issues. And we may get into that today, but it is one of the issues that we're dealing with every day as fund managers. And for those in the room, the compliance requirements keep getting more and more rigorous, and the challenges to meet those compliance issues are getting more and more costly. And with the industry experiencing a shortfall in staff and executives to perform all of those tasks, it's actually drawing us out pretty thin in terms of being fund managers and compliance managers at the same time. But that sort of sums up what I do.
Thank you. I'm Daniel Moat. I'm a senior director at Qualitas. I was introduced as head of legal, and I most certainly had that role up until recently. I've currently shifted into a more product and fund focused role, which is sitting in the capital team. So my role is more now liaising with the capital distribution business, as well as our origination and deployment team in creating funds, working with investors around mandates, and delivering that fund to creation. Qualitas, we're an ASX listed alternative real estate fund manager. We have about 6 billion of fund under management at the moment. The majority of that is in credit or debt funds, and that's a specialty of Qualitas. We do have some core income property funds, as well as some opportunistic funds. In terms of the current focus that Qualitas has at the moment, we're really focused on the residential property sector currently. There are a lot of tailwinds in that sector. We are seeing some real serious housing shortages, as well as forecast deficiencies in the housing stock, and that's been widely mooted, and there are a lot of articles right now that are talking to that point. There's also extremely low vacancy rates. And so when you combine those two things, we have a great degree of confidence in the residential market. And what that essentially needs from the market is more housing stock, and that is medium and high density housing. And so we take a credit lens to that approach. And so when we go out, we're looking at it from a lending perspective, and the offshore capital that, as well as the domestic capital that we're currently seeing a lot of interest in, is certainly around that private credit and that private credit residential space.
Hi everyone, I'm Louise Kale Mulvogue, and here representing the social infrastructure part of our funds management business at Australian Unity. Australian Unity, we describe ourselves as a wellbeing company, and by that we mean that we try to align all our activities across the business towards improving or supporting real wellbeing for our members and our communities. I can talk later on about what we mean by real wellbeing. We've been doing work with Deakin University for over 20 years on the Australian Unity Wellbeing Index. We're also doing work now on our, we call it CSV, community and social value. So we are looking to calculate the S in ESG that we contribute to the community. And so that sort of, I guess, is the underlying inherent approach as to how we go about what we do. From a funds management perspective, most people maybe know us mostly for our healthcare property trust. It's over 23 years old, approaching $4 billion in size. More so in my remit as the younger, newer funds in childcare property, specialist disability accommodation, student accommodation, seniors living, and we've also got a Future of Healthcare fund, which is more biotech, medtech with an eye to the future. So not so much property, we won't talk about that one today. For us, what we're focused on at the moment, we're seeing real opportunities in the student accommodation space. So we're progressing some, I guess, activity on that front, both from the transaction side as well as joining up the capital to fund that. Thanks.
Good evening. I'm Chris Langford from Managing Director of Newmark Capital. And Newmark is a boutique property funds management firm. We've been going about 12 years, have a series of single asset unlisted funds or syndicates, as well as an ASX listed REIT, about 1.6 billion of assets under management. Some of them are big and lumpy. The Como Centre in South Yarra, which has got office, hotel and retail components, and some are just sort of smaller, single tenant like a Bunnings. So a bit of everything, active and passive. And, you know, the market's in great health out there, isn't it? So it's lots of exciting things to talk about tonight, Vanessa. But I think, you know, our job, I should say, is problem solving. And, you know, those problems just every day, they're just a bit different. And, you know, we've got, you know, some active projects with construction happening, and construction prices obviously increased the last 12 months or so and not looking like coming back anytime soon. Obviously debt costs increasing. So all sorts of challenges, but, you know, I love the dynamic of it. No shortage of opportunities out there. And, you know, we're also being a little bit acquisitive at the moment. We're seeing some good buying, and, you know, some sectors that have had a lot of money pushing them and prices up the last few years, not necessarily retail, Melissa, just, but having a purple patch. But, you know, through COVID, everyone formed their own views on what was going to happen and what might happen. So there was not as much money pushing some assets forward. And then, you know, we've seen office recently has become a bit of a dirty word, because people think, oh, no one's going back to work, but a lot of portfolios are really well occupied. And you know, the market seems to be anticipating a lot of things that aren't necessarily coming to fruition. And I think a lot of us up here probably feeling the impact of that anticipation. And I think our job is to sort of pick out what will really happen, because, you know, we make long-term decisions. We invest for minimum 7 to 10 year horizon. So whatever the noise is right there now, we have to ask ourselves, what will it be like in 5 or 10 years? So that's, it goes a lot of those sort of conversations around our meeting rooms internally. And that's, you know, I guess how and when we take a conviction position. I was at a property function in February 2020, and bids were closing that week on the David Jones building in Bourke Street Mall. And the guest speaker at that breakfast was a Macquarie Bank person who wasn't allowed to travel from Sydney to Melbourne to be there. So they did it over Zoom, which was at that point, you know, this very early COVID thing. We thought that was a bit extreme. This isn't going to be that big a deal, is it? But if they're not traveling to Melbourne, you know, maybe no one else is going to be flying down to inspect the property. So this could be a good opportunity for us. So, you know, we end up buying it in the middle of the city in lockdown with a department store tenant that everyone thought was going to go broke, and, you know, it was the end of the world. So I think that, you know, that's an example of the sort of the high conviction. I think we've got lots of challenges out there right now. So I guess we've got to pick which ones we believe in and which we don't. So thanks.
And in terms of what people are believing in, Chris, and for the rest of the panellists, given that there is obviously quite a bit of diversity in the asset classes that you each focus on, what are you seeing in terms of what investors want, and has that changed at all over the recent period, particularly between sort of Australian and offshore investors? Chris, do you want to start with that one?
Yeah, first. I'll take the first part of the question as to, has it changed? Yes, is the simple answer.
Yep.
It very, very much has. And I think, you know, as we've seen volatility and, you know, particularly with the RBA, you know, not very helpfully coming out and saying back in late 21 that there was going to be no interest rate rises till 24. You know, I think a lot of people made decisions at that point. I mean, 3-year swaps were at a certain pricing. You know, everyone's going, oh, it doesn't make any sense. Why would you go and hedge your debt? You know, a whole lot of other things like that. So I think that just that volatility has meant that investors have been, you know, not having a lot of faith or trust in taking that long-term decision. A lot of money, I think, has gone into credit funds and investments that have a shorter term horizon, higher return, on the face of it. And I think that has become the sort of the benchmark by which people are making their other investment decisions. Is it a better or worse return? Is it higher or lower risk as they perceive it? Otherwise, I'm just going to sit there and wait. So I think waiting has become the preferred default position, and they will react if they see a compelling proposition. And now recently, there've been a few things that have mobilised them enough to say, yeah, I'm compelled to do something. But yeah, they've definitely changed their expectations, and the first thing they're looking for is a higher return.
And Daniel, what about your experience in dealing with sort of offshore investors versus Australian investors, and how that's sort of changed, or the difference between what they're asking for at the moment?
Yeah, it's been something that is been moving quite quickly, and I think very recently one of the key messages that we keep hearing from our offshore investors is that Australia is, probably 6 months behind where the US is currently. We're behind where the Canadians are, and when you're at a global institutional investor, the relativity of returns between Australia and the US and other markets is extremely relevant. And so, picking up Chris's point, the willingness to take a view on certain cap rates or certain assets when you can, achieve and generate a very attractive risk-adjusted return in the US, for example. Why do you need to take a view on a certain asset in Australia at the moment? You don't need to do that. And so we're certainly seeing that message being delivered from an equity side of things. From a credit, I think, again, the underpinning of the residential sector story, the growth around the non-bank lending sector in Australia and the retreat of the traditional banks has just resulted in a lot of activity from our perspective in private credit. We think that the uncertainty of where interest rates are going is feeding into that as well, because whilst there is a great degree of uncertainty, then the majority of the loans being written right now is on a margin plus basis, and so that feeds into the returns that the investors overseas are experiencing. A couple other things that's an interesting one offshore is also what is described as a denominator effect amongst some of the investors as well, in the sense that they have an allocation that they need to abide by, and it's either public or it's private or liquid or illiquid. And when their liquid portfolio values are coming down in the sense that they have recently, then their allocation to the illiquids also come down. And so we're seeing that play out as well. Is the actual willingness of allocating additional capital across the board is being kind of dragged down because of the devaluation effect of some of the liquid securities.
And Louise, are you seeing sort of, I guess, given the wellbeing mandate that you have and the focus there, investors wanting particular things in relation to ESG, or do you have sort of different investor pools that are driving your funds?
Yes, is probably the short answer, in that investors now are asking more about impact. They're wanting their funds to go to work and for social value. When you try and unpack that as to what they mean by impact and how they measure it, they haven't figured that out yet either, and it seems to be on a case-by-case basis. Probably before they get to that point, though, the fundamentals of property investing and risk-adjusted returns sort of provide the initial screen. So it's not that they'll invest into something purely for social value. It becomes, I guess, a lens when they're then making decisions between how to allocate capital. But I guess we at Australian Unity have tried to lean into the gap that is, how do you measure S? So I feel like that where this space is lagging where the E was sort of 5 or 10 years ago, how do you measure the E? There's been a lot of work around that. We've got Neighbours, Green Star, GRESB, those sorts of industry understood metrics which allow investors to compare opportunities when they're looking to allocate capital. S, from what I can see, isn't as crowded, I suppose. There are more opportunities there. So we're now into our 3rd year of calculating social value for Australian Unity. And to give you an example as to how we do that, in our, I'll take our specialist disability accommodation fund, we look at the accommodation that we are providing to participants is the alternative for them has likely been an aged care facility or a hospital bed, or even the family home, which causes stress on the family. And so by being able to provide accommodation that is that gives them the independence to live by themselves or how they want to live, that's actually a saving to government and to having to fund those alternatives. So we figure out what that saving is, and then we say, well, part of that, a majority of that service for that participant actually comes through the SDA provider and the CIL provider, we're the landlord. So we give allocate that value, a lot of that to those providers. Then as the landlord, we say, well, we're the fund manager, we're not providing the capital, so capital get a chunk of that. And then what's left, we say is the social value that we've contributed to society for that offering. There are 2 disclaimers I'm supposed to include in this.
One, it's okay, lawyers are all right with disclaimers, so I'll let you.
I'm amongst friends here. So the first one being that it is audited. So PwC do an audit of our calculations to make sure we're not just dreaming this stuff up. And then the other bit is discounting. So that bit that I said was our value, we do apply a heavy discount on that. So discounting is driven by, if it's in a space where there are other players and investors can get access to that in a multiple way. So childcare is probably an area where there's more competition than SDA. So the value we attribute to our childcare fund is less, like the discounting is heavier for childcare than it is for SDA. So I guess we're trying to lead the way in some ways in calculating. Yes, we do that. We replicate that type of calculation across all of Australian Unity. So not just in our property funds business, but the broader funds management business, our health insurance, our bank, our seniors living, aged care and retirement villages as well. And last year, we believe we contributed $1.6 billion of social value to the Australian economy. We're looking to do that calculation again this year, and hopefully it's bigger. And I think actually though, the most important thing is the value of these measures really comes through industry understanding of them and getting on board with them and everybody using them. Otherwise, capital look at their investments and they've got one social measure for a slice of their investment. They go, that's great, but I can't measure other things against that. So I think more work in this space is really going to help investors address that impact need that they want their investment to have.
Yeah, it feels like there's going to need to be a shift towards being able to objectively measure the S and the G when there's so much focus on the E at the moment. Melissa, are most of your investors that where you do get sort of ESG queries or drivers from investors, are they primarily focused on the E at the moment, or what are you seeing?
A range of all 3, actually. Well, I'm a female fund manager, so that's the first thing in terms of diversity and inclusion and the S part to some extent. But in terms of the market, I would say, and where investors are, so as a fund manager, we've all reaped the benefits of lower for longer and interest rates being lower for longer and funds being like a really attractive investment opportunity. And now we're really reaping the benefits of a lower for longer with the REITs, because the REITs are trading so far below NTA that they're not really doing anything. And so whilst the REITs are reporting on ESG and all the exciting things that are happening in that space, they haven't really bought anything. They're net sellers of real estate. And the Australian property investor, whether it be institutions or mum and dad investors, wholesale investors, actually does understand property to some extent. And they're actually starting to see real value, whether interest rates are slightly higher than what they were 12 months ago, in coming back to the space. So if you're buying well, and to Chris's point, there's some pretty good opportunities out there at the moment. And if you're buying well and you can capture an asset that has a number of ESG initiatives already built into it that you're essentially not paying for, because no one really knows how to value them at the moment, investors will jump on board. And we're seeing it play out at the moment. If you can buy assets that are available across certain asset classes, there's a thin buyer pool. We've still got a lot of offshore money looking to come to Australia that isn't quite sure whether or not today is the right time, but they're certainly looking. And I think, I mean, I've answered a couple of questions there, but yeah, investors are pretty savvy and they're looking at all sorts of things. And then the larger investor, I mean, we've got a lot of assets that we've acquired that have substantial solar panels and embedded electricity networks and, you know, waste collection points. And when you work in retail, there's a number of touch points, but we don't actually have a Green Star rating system. So, I mean, that will come. And then I think the scrutiny around that will be a lot more rigorous, of course. But yeah, there's a lot of things that investors are asking for that are not really quantifiable, but there's a real strong mandate towards responsible investing and social awareness.
Yeah. So on the, I guess ESG has been very topical for everyone for a long time, as have interest rates that have come up a few times already this evening. Probably one for Daniel, and I'm not going to ask Daniel to predict where interest rates are going, but so there's obviously interest rates, and the cost of debt has impacted real estate investment a fair bit, and has obviously provided quite a lot of opportunity for in the private credit space. Having been in that space even before sort of the current interest rate environment hit, what are the sort of main developments you've seen in the way that it's impacted real estate lending?
So yeah, I certainly won't be answering the question of where interest rates are going. But I think last week it was already kind of mentioned, but I think last week, I think 100% consensus of no rate rise.
Yeah.
And then there was a rate rise. So it's the uncertainty around the interest rates, which I think is the takeaway, and that is leading obviously to a lot of the discussions and the issues we've already spoken about. I'd say that the approach to a rising interest rate environment has morphed in the credit funds over the last few years. I think you'll find that most of the credit funds in the income credit side, with the lower for longer environment that everyone was in for a very long time, they were mostly writing fixed rate loans. And then the market changed like that, and you found a scramble then, obviously, to convert this fixed rate loan book into a margin plus. In certain areas of our lending business, in our total return or construction lending, it's always been on a margin basis. But I think that's one of the more immediate impacts, is this appeal to a rising interest rate environment equals a rising return for credit investors because of that.
Yeah. And in terms of challenges people are seeing coming out, obviously the cost of debt is putting pressure on returns and value. You know, there's been a lot of discussions about valuations and timing and sort of market nervousness around that at the moment. What other challenges or sort of asset pressures are you seeing at the moment? Maybe Chris, if you want to start us off with that one.
Yeah, I think there are a lot of things happening. I'll call them the clues that would indicate that this and this and this should lead to that. And we're seeing this and this and this, but we're not saying that. So, you know, it's just that not necessarily the logic flowing. So yeah, everyone's certain there are going to be valuation impacts. And I'm not saying we're not seeing them, but they're nothing like what everyone was sort of talking about. And I think the reality is that, yeah, we had low interest rates, but property values and cap rates there was a standoff. They were never going to keep coming down because everyone knew that interest rates, you know, in Australia anyway, we've got decent memories, or maybe not. So I think, you know, to try and then correlate interest rate rises to where we were 3-4 years ago, which everyone sort of says, well, that wasn't normal. I mean, it's just not historically normal. So, to try and sort of apply a logic to it, I think is flawed. But what are we saying? We're seeing some softening. There is definitely a gap between the bid price and the ask price. And when a transaction doesn't occur, the valuer can't use that as market evidence. So there's quite a lot of that happening in the market, and whether it's being reported or not. So there is definitely a gap between the money and the vendor. But the reality is the vendor is not under pressure. So you don't need to do a deal. So is that a market? I don't know. I mean, and I'm not trying to avoid the question, but there is this, as I say, all the things would lead you to believe that there will be, I don't know, 50, 70, 100 point impact on cap rates, except the people who own the properties don't agree with that. So, you can tell them it's worth something else, but they're not going to accept it. So there's a bit, again, this standoff will, I think, persist for a while. There are definitely transactions occurring. There are definitely some transactions that are being structured in a way that is good for the buyer and good for the seller when they do meet. And if anyone tries to sort of stand back from the outside and pull it apart, well, good luck, because it's not, it's not just a simple capital sum. There's always income guarantees and other adjustments. So, I think it's going to be like that for a while. I think it's going to be, there'll be some select transactions. There are definitely listed REITs who want to sell to reboot their balance sheet, fund forward projects, particularly in the office space. Maybe less so in some of the other sectors, but there's certainly quite a few retail opportunities that have been around lately, and Melissa and Haben have been able to take advantage of, and others have taken advantage of some of those opportunities. So, yeah, I think, but they haven't been, I won't call them dramatic changes to book value or cap rate. So there've been some subtle and some structured deals in that lot. So, yeah, I think it's going to happen, continue to play like that. And that's been going on, whether it's been reported as such. It's been going for over a year now. We'll go through the June 30 evaluation cycle. There'll be some more, tweaking 25 points here and there on cap rates, I think. And they'll probably go all the way through to the end of the year and maybe into next year. So it's going to be a gradual, I think, movement. It's not going to be a sudden snap. And I don't think it's going to, when you look at a lot of the listed REITs trading, including NPR, which is trading, they're trading at 20+% discounts to NTA because, the market thinks all these things are going to lead to that. And it's just not playing out at this point. I'm not trying to be Nostradamus here, but I can't see that there is the pressure on the vendors to do anything otherwise. They've got income producing assets. They're generally well occupied. Even office buildings, with 90+% occupancy. And the banks are supportive. So, I mean, unless Daniel wants to sort of change his attitude, I think the non-bank lenders maybe, they'll have a different view, but the big banks seem to be supportive, and there is not that pressure on the vendors to dispose of assets for the most part. Of course, there are exceptions, but that's what I'm saying. It's a long answer, sorry.
And Melissa, what about in the retail space? Are you seeing challenges there, or a similar position to Chris?
First of all, I'll touch on the whole market. So I think and we do a lot of discussions, we have a lot of discussions with valuers across all asset classes. Valuers at the moment are taking a very cautious view in relation to where 30th of June reporting will be. And we need to collectively, as an industry, understand that any major changes to cap rates are essentially going to affect the major super funds of Australia. It's Australia's largest investor pool, and majority of mum and dad investors are invested in CBD office. Now, I mean, I touched on it before, I do a lot with the property funds industry. Right now, retail is actually enjoying the benefits of people working from home. So as much as interest rates have gone up and there's inflationary pressures, we have not seen a reduction in sales. our sales across our portfolio, and we're weighted not just to smaller retail. We've got a number of regional shopping centres that are trading at higher levels than they've ever traded before. Now, I mean, I can talk a bit of tongue in cheek in that, and I do actually say to some of the fund managers that sit on our PFA board that they're the people that should be in the office that are shopping with us at lunchtime. But if we can bring those shoppers into our centres, they can certainly get those people back at their desk. And Australian investors need them to be back at their desk. So I'll just say that about an industry point of view.
Yeah.
In the retail space, retail was disrupted some years ago. We had a lot of concern across the sector about online shopping and what that would do to retail long term. We also had a lot of disruption amongst discount department store operators and even now department store operators. Like, what's the longevity of those big boxes? We're very conscious of any centre that we look at in terms of what those majors are trading at. But the industry has had a shift, and we've had a closure of a number of discount department stores. We had Target close a lot of stores, reconfigure those, convert them into Kmarts. What investors in retail are very aware of is that the rates per square metre of a discount department store are generally around $200 a square metre. That's well below what the average rate per square metre is for the centre. So whilst some people would say that that's a risk and the sector has risks because of that, it's about understanding how to mitigate that risk and actually whether it is actually a risk to begin with. We do a lot of repositioning. I spoke about value creation. And to Daniel's point, most of our property portfolio has residential mixed use as an overlay across our adjoining allotments. So, you know, retail, if you listen to any of the major landlords present on panels like this, and you talk with Centre Group, Vicinity, GPT, they no longer talk about retail, they talk about living centres, and they talk about what retail looks longer term. So our in-house view is very much that. And across our sector, we're seeing, you know, big boxes convert to office, huge medical centres. We've had universities come into other, not our centre, our centres, but in retail. So there's a lot of opportunity across the retail sector for repositioning and converting big boxes into other uses, which I think mitigates the risk of retail, you know, for any investor.
Yeah. Daniel, did you want to say something? Were you just grabbing the mic?
Just grabbing the mic. I'll steer clear of the retail space.
Well, while you've got the mic, Melissa mentioned how important, obviously, superannuation capital is to real property. And you've, in terms of what you're seeing from superannuation investment in the credit space, are there particular underlying real estate assets that the superannuation funds or larger funds are focused on? And is it that build to rent residential space, or are there other assets that you think they're are sort of star in the eye assets?
It's an excellent question, and probably a little bit flippantly I'd answer it to say which is the opposite in terms of build to rent at the moment. We have a joint venture with the Gurner Group, and so we're a big believer of the build to rent. The build to rent sector. It's supported by the same residential fundamentals, you know, I spoke about earlier. But the vast majority of the investor capital for build to rent is coming from offshore. In a traditional build to rent product, there are some very, very effective affordable housing or those type of products being supported by some super funds. But the general consensus is that the domestic super funds are waiting to see how the market goes. And so they're waiting for the offshore investors to cut their teeth. They're waiting for the market to develop. The build to rent products, generally, there's been a couple that have stabilized now with Mirvac, but generally they're still in construction. They're waiting for stabilisation. They're waiting to see how the rental underwrite yields come out. They're waiting to see how secondary trading goes on the assets, where cap rates go. And so until that happens, our view is that there's going to be some challenges with the domestic super funds coming into this space in a big way. And just on that, I think it's telling that obviously we've had the announcement last week on the changes to the MIT withholding exemption. So the cabinet has announced that they're going to be essentially bringing the build to rent MIT withholding rate into line with other property sectors, so that there won't be there'll no longer be a 30% withholding rate. I think that in and of itself is evidence of the need for this offshore capital to come in to support this build to rent market. So yeah, it's a very unique kind of niche build to rent answer, but I think that's it's a really good indication of where they're at the moment.
And do you think it's just nervousness around not being as familiar with sort of the rental market and residential rental market and model, whereas Australia seems to have more of a traditional, or it hasn't had the housing shortages that other overseas markets have? Is it just that familiarity, do you think, with the offshore capital?
So I think from an offshore perspective, there's two things. There's a great belief and there's a great understanding that Australia, a top 10 OECD, we have such a stable regulatory environment. Our legal system is very clear. So there's a trust in the Australian market from a property perspective, specifically that the offshore investors don't need to get across. They just understand that that is a safe environment. So that's kind of the first tick in terms of their analysis. And the second tick is exactly, you're right. It's saying that the multifamily and the build to rent sector in the UK and the US is just absolutely exponentially larger than where Australia is at the moment. And so they know where this goes in some ways. And so they're willing to take a through the cycle view on housing and residential and leasing that the super funds currently just aren't willing to, from our perspective, aren't willing to back in a kind of general way.
Yep. We might move to questions from the audience now. So do we have, does anyone have any questions from our panelists, for our panelists? Ria will come around with the microphone if you do. No, just the microphone. Yeah. James? Yep.
Say Ria. So I work within the Hall and Cox Corporate Funds Group. One question I've got for the panel, we talked a lot about economic implications of the current funds market, but thinking about regulation more generally, our perception at Hall and Cox is that the regulators aren't stepping back. In fact, they continue to turn the screws. It's not just ASIC, but with privacy reform coming through, that legislation has been a further review at tighter reporting requirements that other jurisdictions. So what I'm interested in is when looking at your business and developing products, does that regulatory environment and really impact your decision making? And is that more prevalent now perhaps than it has been in a number of years?
Given I've got the mic, I guess I'll go first on that one. I guess for us in the social infrastructure space, where we see that regulatory impact the most, I guess in relation to the NDIS and how it impacts for our Specialist Disability Accommodation Fund. So there's lots of media and headlines around, is it viable, can it be funded, should it stay, those sorts of things. In my mind, it's an insurance scheme that's solving a problem the government doesn't want to go back to. So they don't want people with disability in aged care homes and in hospital beds. So regardless of who is in government, it will stay. The problem is it costs more than Medicare, I think. So it's something that will always be tweaked and there will always be change. Hopefully that's around the edges, not fundamentally what it is looking to achieve. And I think for us, for social infrastructure and taking that longer term view of it, that's, I guess, where we get the comfort that fundamentally it's doing what it needs to do and will support the sector. So that's obviously a very specific answer on NDIS and the SDA. So I'll let others.
I think I guess yeah, our AFSL sort of licensing issues when we started Newmark 12 or so years ago. Very well advised, thanks, Harry. When you know, we went out to, we were door knocking trying to raise funds, and post GFC, all the financial planners, as they were then called, said, don't even waste your time, don't even make an appointment, we're not talking to unlisted property syndicates, startups or business, forget it. And so by default, most of our, not most, pretty much all of our investors, the first 2 or 3 years were high net worth privates who was just sort of that networking and referral arrangement, because that's none of the advisors, they were all they'd all been either beaten up by bad investments in illiquid funds or by the regulators who had basically, you know, found out the fact they were all receiving commissions and they were giving their clients bad advice. So, you know, the regulation there was, I think, really important to the health of what we do now. You know, without it, we wouldn't see the a lot of the inflows that we've had from the wealth advisors and other sort of related advisor industry. And back then, unlisted private property syndicators like us were pretty much on the nose. And now I think we've got a very good, healthy industry, and there is none of the shonky sort of practices that happen. So, you know, that's all pretty obvious. I know that's not really answering your question, but you know, since that time, we've seen, you know, on the investor side, our investors, they've gone through regulatory change and royal commissions, and you know, so our clients can, the way our proposition and how we engage with those investors is constantly changing as a result of regulatory change and higher requirements on their advisors and the advice they give to their clients. So, you know, it keeps us on our toes. It's certainly not, it's not dull and it's not easy, but and it makes, I don't think that necessarily it makes the process we go through in preparing an offer document massive. It's always hard, well, hardish, but you know, it's important you get it right, and I think, you know, that best practice sort of approach. But you know, I think the being attuned to what's happening for us in the whole regulatory space, not just as it directly impacts us, but as it indirectly impacts us, is really important. And yeah, it's going to keep changing, I've got no doubt.
I might just add one thought, which is, I think, James, one of the impacts of all of these things that are happening is it's just taking a lot longer to do everything at the moment across the board. It's taking a lot longer to raise money. It's taking a lot longer to deploy. It's taking a lot longer to frame your operational risk environment. And I don't know whether, you know, we're having a tough start to 2023 from a consultation process, but there's a half dozen consultations currently out there: thin capitalization, MIT, AML, CTF, going to real estate fund managers now, privacy, we have cyber. So it just seems like there's just an onslaught of changes that are coming through, and that will all just take time to work through, and it will just suck up more resources across the board. Now, to Chris's point, it's all hopefully for the best, but it does take away from the actual core business of what we're trying to do sometimes.
And Daniel, does it actually increase the cost to the ultimate, I mean, in a significant way,
Yes.
to the investor?
Yes.
Yeah. And do regulators understand that?
It's funny that they always couch some of these consultation processes with, you know, outline the impact. They always have it in the question. And I never know where it goes. So yes, the answer is it does. And again, some of it, and I don't mean to be negative on it, some of it we absolutely need. But it just seems like between ASIC and Treasury and APRA and a few other things, it's just the coordination across all of this happening at the one time. Sometimes it just feels it's too much.
And sorry, I'm hogging the rostrum here, but I'm really interested in is how would a revision of the definition of a wholesale investor impact your businesses?
So I was actually going to answer that before you asked the question.
Sorry.
Harry. So Hall and Wilcox are actually reviewing our license at the moment. So I'm a responsible manager and key person with our AFSL. All of the changes to the MIT, the review of wholesale investor test, obviously for fund managers, once they change that test, that will impact our businesses, because at the moment, and I heard this discussion at a barbecue recently where they said every Sydney pool cleaner is a wholesale investor now. And so, I mean, whether or not that means they're an educated investor or they understand the market, I mean, the test has been around for a long time, but absolutely it will impact our sector. We're actually lodging for a retail license right now, but the cost of that and the compliance level to administer that is significant. And we're talking hundreds of thousands of dollars per annum. So it actually has to impact investors because it's an upfront cost that the business wears. And then you've got to have independent directors. And I mean, it's great for improving the industry as a whole. But I will just say this little story. So through COVID, as an association, and Harry will be well aware of this, we had numerous discussions with ASIC around hardship and whether unlisted funds should be offering retail investors provisions for obtaining liquidity. And at the same time, the share market was falling substantially and investors who had liquidity were losing money every day. Now, I think that's sort of a bit, it's a very interesting point that the unlisted sector has performed really, really well because it has illiquid investments. And the listed market is now trading, and we talk about it, like around 20 or more % below NTA. Now, I don't know what benefits investors more, that or being tied up in a fund. And I mean, we're talking with many fund managers across the industry and many mum and dads, and I can name some major fund managers, which I won't, had no hardship requests across COVID. And yet ASIC saw that as a major issue to consult with us on as an industry. So what that means, I think, I mean, it's just worth thinking about, because I think we actually, as unlisted managers, cop it a very hard stick. And I think it's often unjustified, and we wear the cost of that.
Were there any other questions from the audience? Might be about it.
Well, we've got a few fund managers in the room.
John? No.
Chris, you mentioned earlier the 20% discount that the REITs are trading at. What do you think it'll take to close the gap?
Pull my punches there, John. It's a good, I'm not sure there's ever a simple one answer. But I think, you know, really, I could waffle on for a while here, but pull myself back. Okay. Post GFC, I think all the REITs went off to Cairns or somewhere for a bit of a talk fest, and they all you know, sat around the campfire and said, "We're never going to do this again. We're never going to do this. We're never going to. We're not going to have gearing. We're not going to do development. We're not going to have all these other fee streams. We're going to be REITs, and we're going to be, you know, safe and reliable, so that when a financial crisis comes along, that people are going to be able to distinguish between shares in industrial stocks and tech companies and investments in property trusts." And, you know, they all had a series of principles, and that was going to be the way. And, you know, I think it lasted a couple of years, and, you know, then everyone started sort of getting a little bit funky, a bit different. But, you know, so it really annoys me, and hopefully a few others, that, you know, when there is volatility in the market, the counterbalance is supposed to be the REIT sector. But unfortunately in Australia, we don't have a whole lot of property securities funds. We don't have a whole lot of big super funds that are in the REIT sector for exactly that reason. It doesn't seem to have the counterbalance or the gravitas that it should have. A lot of obviously the super funds do their own thing in property. They don't rely on the REITs to provide them their exposure to real estate. I mean, I'm generalising here, but so yeah, I think it's now just seen as another industrial stock. It goes up and goes down with the market rather than, as I said, providing that counterbalance to the volatility. It should be much more stable. So I think whilst people look at it as being that, oh, we're a bit fund manager, we're a bit of a developer, we're a bit of a, diversified, we're not, there's so many different thematics within the REIT sector that I'm not sure that gap's going to close. I think at the moment, there's going to be probably, a consolidation and delisting so that it's down to fewer, bigger REITs. I think that's going to be the issue. I don't think it's going to sort itself out just on a pricing basis alone.
Anyone else have any questions for our panel?
Just wanting to find out whether any of you have seen tangible or noticeable impacts post having to do target market determinations for retail funds in terms of distribution and take up of your products.
So we do have a listed credit fund that came within the TMD determination environment. We're probably a bit unique in the experience, unlike what Melissa's journey is on a retail license. We do have Perpetual as the responsible entity of that fund, and so from our perspective, it was a very clinical and it was a very transparent process that we went through, because we had the support of the industry body, we had the support of Perpetual, and also from a fund management perspective. In terms of our distribution strategy, no, I think is the answer. At a very, very simple.
Let's stop work orders. So across the industry, I'll say that there's been a number of fund managers called out for breaching their target market determination. And they've been called out with stop work orders. Now, the challenge for that is a number of ASIC are calling out people without people having had an opportunity to even respond. So from an industry point of view, it's actually very challenging for those people that have that happen to them. And their name is blacklisted almost. It's sort of a very steep barrier to entry if you're coming into getting a retail license, knowing that could potentially happen without a right of reply. And it's pretty horrific for it to happen to you. I know Harry's got some opinions on this.
Needless to say, I'll do lots of work for lawyers.
So I don't want to comment. Can I just add one, John? I think my answer for Newmark is that no, it hasn't helped our investors at all. When you're dealing with retail investors, you're dealing generally through advisors. The amount of information, the amount of complexity through accounting standards and so on, I think by the time it actually ends up in the hands of the investor and even the advisor, they're focused on so many other issues that I don't think the information that's provided to them in a TMD helps them with their investment decision. So yeah, I think it's way of just really distorting a whole lot of information into a level that is probably not helpful to the investor ultimately. And does it help the advisor? I don't think so.
maybe last question is, each of you to give us your property prediction for the next 12 months. Whatever they want, just a parting word.
I don't even know where to begin with that. I guess for us, the drivers for cash flows in social infrastructure, and I guess I probably should have started this with how we define social infrastructure, being the interdependent mix of people, services and places that support wellbeing, that the drivers for our cash flow will remain. People still need somewhere to live. They're still going to get educated. And hopefully they're still working and need to put their kids into childcare. And our seniors living area, they still want security and community connectedness. So those drivers don't change for us.
I probably will not answer the question, but address it on a more macro basis, which is, I think, there's a lot of talk with the RBA and whether they can achieve the soft landing that they're trying to, whether, the good news is bad news or bad news is good news. I think for what it's worth, that there will be a higher for longer approach that will need to be taken. I just think that the economic resilience in the job market with the return of migration and students and the residential property market, I think that the interest rates will continue to be higher for longer. And so I think that's going to have an effect on property. And I think that's going to kind of lead to more distress. I don't know whether we're going to get to a GFC, blood on the streets distress, but I think there's going to be some more opportunities on portfolio trades, some recapitalization opportunities as well. So I do think it's going to get worse, but it's not going to be an acute.
We're really looking forward to the next 6 to 12 months. So even though we're taking the view that it will be higher for longer, market evidence is showing that 30th of June will be wouldn't say Armageddon, but certainly I think interest cap rates will soften across the majority of sectors. I think for fund managers, the opportunity to buy well at the moment is right on our doorstep because the REITs have pulled back. I think there's the small window of the next sort of 6 to 12 months. I think 30th of June will soften potentially 31st of December. I think for anyone who can find the right asset, buying well is key to starting a good fund. There's still opportunities in the market across all sectors where there's liquidity issues with investors where they have to sell down. So I think if I could give any advice, keep your eye on the sector you most understand. Look for those assets that are trading and valuations that are dropping, and marry that with assets that have longer WALEs and opportunity for income growth, because I think there's a small window that we can all play in and get those assets and buy them well.
Not really. All I will say, Harry, is I think that income line is really important to, I guess, fund managers and ultimately investors, and finding that stability and security of income for the next few years, and income with growth in a high inflation environment is important. There'll be good buying. But I think, fundamentally, Australia, the economy, notwithstanding, as I said, all these signals sort of pointing different directions or leading us to certain conclusions. But I think the economy is still pretty strong. We'll see what the budget delivers tomorrow, but I think the economy has somehow defied gravity again. And with migration tipped, well, we're already seeing increases in the numbers are very, very healthy. I don't think it's as doom and gloom as everyone sort of seems to think that the signs are pointing towards. So interest rates caused and global economics and politics is causing obviously a lot of impacts. But, you know, I think Australia is a pretty good place to be. And, you know, I think if we look through, back to what I said at the beginning, we look through this and we say, well, if you're making a property decision, don't buy it and think it's going to be worth more next year. But think 10 years and just make sure you got that income for the next few years to service your debt. And there'll be some great deals out there. And I think lawyers will prosper.
I hope we all prosper. I'm sure we will. And I thank you everyone.